Cathie Wood just disagreed with Elon Musk. Elon earlier replied to one of Cathie's tweets by saying that he thinks there are a lot of current year similarities to 1929. Cathie says that the echo is more like the early 1920s after a pandemic and a war, the Spanish flu and World War I, as three major innovation platforms were evolving into mass market opportunities: electricity, telephony, and the automobile, contributing to the breathtaking roaring 20s. We, of course, just had bank runs, and there were many bank failures during the Great Depression. Some 7,000 banks actually failed, which I referenced in one of the last videos. And the reasons for these failures were many, but here's one big one. One Midwestern woman, a farmer, made an overnight profit of $31,000 in today's dollars, betting on a car manufacturer's stock. Now, that would not be a problem in itself. The problem is she probably borrowed up to 90% of the money she needed to make her overnight killing on that automobile stock, which was financed by her local bank. Borrowing against stocks that you bought was quite easy, and you could borrow a lot. Today, the regulations are very different. You can't do it to that extent. And some of that speculation certainly caused the roaring 20s. That was one of the reasons. But then as the market started crashing, you had to sell all of your stock because you got margin called. But then the prices kept falling down even more because everyone else was also selling. And so many people could not pay back the banks, and the banks lost their asses because their loans went bad. And then there were runs on these banks, and these banks went bankrupt. And this vicious cycle just kept going down and down and down and down and down. Terrible time. Hopefully we never have to go through that again. Anyway, Cathie continues. In response to a supply chain and war-related surge in inflation, the gold standard forced the newly formed Fed to drain money from the economy, pushing pricing from a 24% inflationary peak in June 1920 to a minus 15% deflationary trough 1 year later in June 1921. Now, inflation, which peaked in the 8 to 10% range last year, is likely to surprise on the low side of expectations this year, dropping below 2% and perhaps turning negative. The banking crisis could lead to bad deflation while innovation generates good deflation. If we look at PPI, Producer Price Index, that is not increasing nowhere near as fast as before. It only increased by 4.4% just now compared to the estimate of 5.2%. The most recent data does suggest that Cathie might be onto something here. Today, 5 major innovation platforms are evolving at the same time. Multi-omic sequencing, which helps us understand biology on a whole different level, and perhaps we will be able to cure cancer as an example of those understandings. Robotics, which Tesla will benefit from. Energy storage, which Tesla will benefit from. Artificial intelligence, which Tesla will benefit from. And blockchain technology, all of which are converging. Tesla is leading the charge in 3, but I wouldn't be surprised to see 4 and 5. Once the Fed stops looking backwards at consumer price index inflation and starts addressing the deflationary banking crisis that a 19-fold increase in short rates and an inverted yield have caused, we would not be surprised to see a return to the roaring 20s. I just hope we wouldn't have a Great Depression after these roaring 20s. But also, on the other hand, Cathie Wood sort of has to say that because her fund is based on technology. And if interest rates stay high, why would you buy Cathie's fund? Because a lot of these companies are not really going to be as cash flow positive as Tesla will relatively soon. It makes sense to hold Tesla stock because the growth of earnings, I believe, is going to be absolutely ginormous. But overall, the tech sector, if the interest rates stay high and keep increasing, I don't know. I don't know about that. I want to agree with Cathie, but certainly there is some bias here. Cathie sort of has to think that doesn't matter if she's right or wrong, she sort of has to think like that. But I do agree, innovation solves problems. Truth will win out. Hopefully, she is right. I certainly prefer lower inflation and lower interest rates. Cathie also tweeted this, which quoted this congressman who said, "Today I sent a letter to the FDIC chairman regarding reports that the FDIC is weaponizing recent instability in the banking sector to purge legal crypto activity from the US." Here's the letter. And on the second page, it asks the following questions. Has the FDIC instructed banks under its supervision to not provide crypto firms banking services? If yes, please explain the analysis for this instruction. Number 2, have you communicated explicitly or implicitly to any banks that their supervision will be more onerous in any way if they take on new or maintain existing digital asset clients? There have been allegations that these bank closures happened because crypto is risky, when in reality these institutions appear to have been impacted less by the volatility of digital assets and more by the unprecedented interest rate hikes we have witnessed over the last 12 months. What if any guidance has the FDIC provided to financial institutions to help them manage and mitigate the risks of rising rates? I don't think any of this had really to do much with crypto. Some, maybe a little bit, okay, I can understand that, but mostly it was mismanagement of these banks because interest rates went up a lot, so you can blame the interest rates, but I really blame the bad management of these banks, that they did not see these interest rates coming. I mean, Silicon Valley Bank specifically made a big bet that the interest rates would not go up at all. There are ways to protect your bank from interest rates going up. You will make less money, sure, but your bank will not go bankrupt, at least, if the interest rates do go up a lot. And accusing crypto of these bank failures, I'm not sure that's a great idea. I don't think we really want to push crypto out of the US. So let's see what Cathie says here. If you are correct, Congressman, then the FDIC and others will prevent the US from participating in the most important phase of the internet revolution. Like you, I believe regulators are using crypto as a scapegoat for their own lapses and oversight of traditional banking. Despite a yield curve that inverted last July and credit default swaps that started flashing red, which means banks are probably going to fail, or at least there is a lot more risk in the banking system. The Fed continued to vote unanimously to jack rates up in 75 basis point increments. They paid no heed to commodity prices and other inflation indicators that were unwinding. It's a little bit like driving a car and you're looking at the rear view mirror. That's sort of the approach that they are taking. And it has certainly been quite effective at reducing inflation. But this is all at a price of banks collapsing. Cathie thinks that we no longer really have inflation. The Fed thinks that we still have a lot of inflation. So what the Fed does going forward will really show us, is the Fed really serious about destroying inflation, because they think there is still a lot of it. And if the interest rates do not go up, and even more if they get cut, that may be a signal that the whole banking situation right now is a lot worse than many people think. So in a way, actually, the Fed may send a better signal to the market by not increasing or decreasing the interest rates. The decrease might be the scariest thing, because that shows us we are in trouble, because the Fed has been talking about destroying inflation. And if they U-turn, that to me is a signal that our banking system is in trouble, which to me is worse than inflation. We're having to deal with very high interest rates. Crypto had nothing to do with the bank's investment decisions, nor the Fed's decision to jack up interest rates 19-fold in less than a year, incorrectly assuming that it was fighting a 70s-style inflation. The Fed caught many regional banks offsides with unrealized losses. Because they intended to hold the long-term securities to maturity, banks did not have to mark them to market unless sold. They would get their principal back upon maturity despite subpar returns in the interim. Unfortunately, the second assumption, stable to increasing deposits, also was incorrect. Venture funding dried up, so startups started draining their deposit accounts, and elsewhere, uninsured money market funds started bidding for accounts with 4 to 5% interest rates. The asset-liability duration mismatch, securities earning only 1 to 2% versus deposits paying 3 to 5%, became untenable as deposits started leaving the system. Like Silicon Valley Bank, some banks were forced to sell hold-to-maturity securities, recognizing losses that depleted their equity accounts. Crypto did not force Silicon Valley Bank and Signature into bankruptcy. In my view, Fed policy was the primary culprit because of a VC funding drought and higher yields on money market funds. Deposits left the US banking system. It makes much more sense for Cathie Wood to blame interest rates instead of bank management because it benefits her fund. So I would expect that, but I would disagree with her that it was primarily the interest rates. I think it was the management of these banks. I am baffled that banks and regulators could not convince the Fed that disaster loomed. Did they not understand that the asset-liability mismatch, normal in most circumstances for banks, was untenable as deposits left the banking system for the first time since the 1930s? This debacle would not have been possible in the decentralized, transparent, auditable, and over-collateralized crypto asset ecosystem. Indeed, during the last week, crypto assets have behaved like safe havens. Along with gold, their prices actually appreciated. For example, Bitcoin is up about 18%. In our view, crypto is a solution to the central points of failure, the opacity and the regulatory mistakes in the traditional financial system. Made the scapegoat for policy mistakes, crypto will move offshore, depriving the US of one of the most important innovations in history. I don't think we want the US to be weak. I think we want the US to be strong. I think we want the US to continue to innovate, and I don't think we want to force all of the cryptocurrencies out of here. That does not seem to be a good idea. And you know what may be a good idea? This. The Tesla stock buying opportunity explained by Elon Musk. You may watch it right here if you haven't yet. My name is Matt Posius. Like and subscribe if you haven't yet, and I will see you in the next video. Thank you so much for watching.